Now we're going to turn a little bit more towards the emerging markets, Asia, and what's happening there. And before we get into it, again, please like, share, subscribe. Your comments are always welcome because we've been talking a lot about China, why we have fears on China and what that looks like going forward, just given the backdrop of on a geopolitical side, on an economic side, and where things sit going forward. So this is an interesting one because this looks at emerging markets versus mature markets. So when we look at government interest expense represents a heavier burden for emerging markets, it's not going to change. So mature markets have gone down, obviously, because you have negative rates, you have things that have been beneficial. But when we look at emerging markets, that's where we see the biggest overhang and something that we've been talking about, exponentially since, really, if you know me, it's been a comment that I've been talking about forever, especially since 2010 and then again in 2014 when we saw a big increase in US dollar denominated debt. And now we have another surge and another increase in bonds. And as we talked about in the second segment, there is a significant amount of debt that has to get rolled. And as that debt has to get rolled in 2021, at what interest expense is it going to be rolled at? What interest is it going to get rolled at? And is it going to be a higher cost as the yield curve starts to shift higher? And that's really driven based on inflation fears in terms of level of debt, leverage on the sheets. And that's why, when we look at emerging markets, this is where we continue to see that pressure, which is why when we look at, the US dollar, a weak dollar obviously helps that, which is why dollar negative usually has a positive backdrop to some of these moves. It's just we think that's going to start to get shaken up, especially as the data continues to worsen at the emerging markets. And it's on a COVID level, it's better, but I'm just looking at if the mature markets, developed markets are the ones that are the biggest buyers of stuff, well, what is going to happen as we go forward and we continue to see these pressures overall, just given the amount of debt. So speaking of debt and the people who perfected the term, let's look at Japan first. So when we look at Japan, you have to look at PMI. So PMI, when we're looking at manufacturing, was 48.3. Again, slightly contractionary. You can see that we really haven't seen much growth since 2019. On the business activity side, 46.7, again, worsening contraction. PMI output in total on a composite, 47. And then when we look at same convenience store sales year over year, they're down 4.3%. Again, there's been a lot of negative moves overall, and we continue to see pressure not only on exports, but again, also on just internal fundamentals for Japan, which as the third largest economy in the world, this is going to be a meaningful problem, and especially as they continue, like the Nikkei hit an all-time high or the highest since 1991. You have all of these positive moves in terms of price action, but the underlying support just isn't there, which is why it's at some point the two shall meet. One won't come all the way down, the other won't come all the way up. It'll be somewhere in the middle, but there needs to be some recognition that the underlying fundamentals continue to struggle, which is why when we look at third wave COVID, you can see that the confirmed cases, that Japan is also facing another wave of COVID cases, which again, they've managed it better. They're very aggressive in going after it. So this isn't something that is going to be detrimental in the sense of they're going to have to shut down, they're going to have a national lockdown, they're going to have restrictions. It just means that getting back to some sort of growth, which they've struggled to find for the last 5 years, it's just complicated. It just complicates things more. And that's why when we look at Japan, which is a unique specimen in terms of the pressure that they face, then we can turn to South Korea. So when we look to South Korea, a third wave of coronavirus infections is starting to rise. Again, they've been very good at managing it, as you can see from obviously the beginning of March. Then they managed August very, very well. My assumption is that they're going to manage this as well. So again, not the same type of impacts that we're going to expect, but it's just going to slow down as people adjust, as things are addressed to minimize exposures. And that's why when we look at South Korean data, some of it's pretty good. We have some decent data points with discount store sales up 2.3% in October. Consumer confidence, 97.9, increase from prior. Business service survey manufacturing, 81 versus for December versus at 76 prior. Business survey, 72 versus 69 prior. There is a lot of improvements there, and we can see it in the imports and export side. Now, the imports have gotten a little bit weaker when we consider where things sit, but overall, exports have remained strong and have continued to progress. Now, they've been a little bit less than expectations, but still a strong direction. So when we look at exports overall, you can see total exports through the first 20 days of November, they're up 11.1%. When we look at imports, they're up about 1.3%. Again, all of the imports are heading in the right direction, because what does South Korea do? They will import raw materials. They'll import semi-finished goods. They'll export final products. So again, that the increase in imports is supportive of an additional expansion in exports. The question is going to be, who's buying it? Is the buyer going to struggle? This is Europe, this is US, this is Japan, this is China. These are things that we have to consider when we're like, okay, well, the internals are getting better. So far, the externals are improving for specifically South Korea, but will that start to slow down? So far, the answer is no. The question will be, is this a delayed reaction? And so far, we're starting to see a little bit of a slowdown, but again, nothing to say that any of this isn't going to be proven correct as we go into the end of the year. Now, India trade flows are quite the opposite, where we're starting to see a little bit of an adjustment, as we talked about some of the data points in the EIA show, specifically in segment 3, when we went through India, China, overall in terms of oil demand, oil exports. So imports were down 11.5%, again, an improvement month over month, but still down year over year. And if you look at 2019 imports were also down. So if you think about, kind of where things are, it was actually worse. And now when we look at exports were down 5.12%. We had an increase in exports last month, and now exports are back down in negative, even though there's a fairly easy comp versus 2019. And the reason why this is a problem is when we start looking at, the future and India in general, things are starting to slow. And whether or not you want to look at it and say, okay, well, things are slowing because of COVID, or it's a mixture of everything, because they did have a strong backdrop with festival season. So they had to import, they had to move things around. Now that we're getting into November, into December, you're starting to see some of that slow down, some of the adjustments take place, and now COVID cases are increasing post the festive season. So now, this is why when we look at some of these leading indicators, this is starting to say, look, that increase in gasoline demand, that increase in diesel demand, it appears to be a little bit more of a blip and not so much of a strengthening trend. Not to say that oil demand is going to collapse, because it won't. It's going to remain down year over year, but still fairly stable into year end, as we see China taking some of that market share from the export side, which is allowing them to push more on internally, but also it's going to decrease the amount of oil they're importing, because they're just not going to be able to export the same way. And these are some of those internal dynamics that are giving a little bit of a pause when we look at some of the growth in India. Now, when we look at the rise of spending, when we look at central government revenues versus expenditures, this is why when we look at India, we're just seeing a huge blowout in terms of the budget deficit. And this is something, when we look at the inflation numbers that are starting to creep higher, concerns on the Chinese rupee. This is what we're going to point to. This is why we remains a problem, especially as exports slow. As exports slow, that means you're taking in less dollars. If you're taking in less dollars, there's more concern of inflation. If there's more concern about inflation, the central bank can't ease as much and has to raise rates. And if they raise rates, it means that you're going to have to borrow to close this gap at a higher interest rate. If your interest rate is higher, your interest expense is more. If your interest expense is more, it means there's less money to use to stimulate the economy in different ways. Again, an overarching theme, a problem that we see persisting not only in India, but across the globe as we look at the overhangs that's created by debt. Now, when we look at Chinese total debt, now this is a chart I do enjoy the most. When we look at Chinese total debt, hit 335% of GDP. So non-financial corporations, household, government, financial sector. So clearly there is a debt problem, not just in the US, not just on a global level, but also in China. And when we look at the means in which they've used to finance their growth, it's been aggressive since 2009. 2009 was really when they stepped up to borrow, to grow. You had, everything from ghost cities, and ghost cities is just one example of waste, but then you had building of refiners, you had building of petchem, you had ports, you had roads, you had infrastructure that had to be built. So not all of this has a negative correlation to it. It's just now they're continuing to stimulate because they have no choice but to use some form of borrowed money to continue to push through, to try to give this semblance of growth. Like in previous years, they've always had a hard GDP target. Now they have a soft target of 5%. Last year it was 6%. So clearly they're paring back, but this is going to be a bigger issue over time as these again, interest costs money. If I have to pay my interest expense, how am I paying it? And based on the fact that it is a communist country, or it has some form of, if you want to argue it's not technically communist, fine. When you look at who is the buyer of last resort, it comes down to the PBOC. So even though they're not the corporations, that this includes private, this includes state-owned. So there's going to be a backdrop, and somebody's going to be a bag holder. And anybody who is on energy financial Twitter or EFT, or who's been investing in energy knows what it's like to be a bag holder. And this is no different. There is an inherent problem in terms of how this debt is going to be a massive overhang through growth, for the foreseeable future. And when we start to break down, China has failed to break its dependence on foreign tech products. We did a whole show on this in terms of where things are. It was right after, it was called Chinese Communism Rising, looking at the Plenum, the 5-year plan, and that's attacking this. That's looking at this saying, we need to fix this. But as we said, it takes, we did a whole report on it. It costs $6 billion to build a semiconductor facility. It takes, and as there's more complications added to that semiconductor, the estimates are it's going to take $20 billion. It's a lot of money to spend on a country that is already so over-levered and stuck in debt, which is why when we look at the dollar, when we look at FX reserves and gold, this is an overarching concern over growth and growth projections, because they will struggle to find some sort of semblance of strength. And when you think about, okay, well, China still has a lot of sales. They still export to individual countries. India is another one that they initially were a big trade partner with China, which obviously got called into question with the LAC, or the line of actual control, with the fighting in the Himalayas. Now we have, India has banned the usage of 14 online apps and online usages, several of them being part of Alibaba, which you can't use. And this is a problem because not only are you being told you can't do it from a geopolitical standpoint, but when we look at India retail sales, moving average, they're down, call it 40%. When we look at industrial production, consumer durables, year over year, they're down a total, they're essentially flat. When we look at industrial production, non-durables, flat. There is an overarching problem in terms of, okay, well, industrial production has gotten better, but exports are slowing, local demand is slowing, and now you're being told who you can and cannot use based on a geopolitical backdrop, and based on the views of China within India, nobody was already using it, so it's not a huge issue, but these are going to be problems as we look at large growing economies where we're hoping for them to get back faster and to be a driver of growth. Well, the growth remains slow. And that's the overarching theme of kind of what we think is going to happen, looking at China and India in one bucket. Now, when we look at delinquent debtors within China, it's gotten a little bit better. And by a little bit better, I mean the pace of defaults has slowed. But at the same time, we had a plenum meeting. We have President Xi claiming that, or saying that they've now defeated, homelessness and the poor. And they have now said that they have won the battle. And now, mind you, the target date he had set to abolish people who were at the bottom end of the quartile was 2020. So it's not surprising to see that, he's miraculously, and on November 25th, claiming victory that they have defeated poor. They've defeated people who are malnourished. They've defeated this quartile that was their target. So clearly they're going to get some help in terms of, look, I need a credit. I'm going to default. I need some help. They're going to pick and choose who is getting the benefit. But even with that, if you look at 2018, 2019, 2020, we're only seeing an increase, and the increases are getting worse because there's more and more problems on a corporate level, on a purchasing level, which is why the dual circulation system is so important. Create local demand, because we can't export it as much, because exports are essentially less and less of GDP. We need consumer consumption, but every company that goes bankrupt has employees. They have jobs that are going to be lost. There is an overarching problem of not only defaults, debt, growth, but also the fallout from that. And how are you going to support these people that are now unemployed? And that's when we turn to the defaulters face more waves of repayment. So when we look at December and March, you need a liquidity event. Like if I don't have to pay off my principal or roll my debt, I'm not going to do it till I have to. So December is a big period, and then March of next year is another big period. So that is going to be a striking point. So if we go back to the previous slide, when you think about how 2020, the pace of 2020 has slowed versus 2019, well, December is going to be a big problem because these payment obligations aren't going to happen. And if you can't come make a deal with your creditors or roll that debt, you're going to be pulled into default. So December is going to be a tough one, and then March again of next year is going to be a big one. And this is something to watch as we go forward. And again, as we look into Q1, as we look at growth, as we look at GDP expansion, China isn't as rosy as things seem, because a lot of their recovery as well has been driven by supply, not demand. And again, supply is one time. Once you refill those inventories, once you refill that, you're not going to see the same type of buying, and demand globally has been detrimental and slowing at best. And that's why when we look at the bankruptcies restructuring application, so when you restructure in China, you're going to issue some sort of application. What are your plans? What are you going to do? So 43.8% of bankruptcies are restructuring accepted by the court. 34% missed principal and interest payment, missed put option. So it just gives you the sheer size and scale where we almost have 75% that have either been accepted by the bank and or missed principal interest and are going to have to go into some sort of restructuring. Now, it just means that someone's going to take a haircut. Who's going to take the haircut? And is it international? Is it the local banks? And when we look at the banks who are already levered at 35 times and have a rising bad interest expense, as we've shown in episodes previously, this is going to be a problem and is going to continue to see expansion in terms of who is feeling the pain and how is this going to be restructured going forward. As we saw today, like TikTok was granted a 1-week expansion on the deadline to sell in the U.S. That's the other side of the other piece. And I keep saying pieces of the pie as I look at a pie chart. Not only is China facing internal problems, a debt problem, they also, again, have that geopolitical problem. China in the U.S., China in Australia, China in Japan, China in South Korea. There's remains a overarching theme of China overextending, being more of a bully, and people just saying, look, I'm not going to do these terms anymore because your market isn't as rich as you told me it was going to be in 2011. Or it was, and I made some money through 2014, but these contract terms don't work for me anymore, and you can't strong arm me. And that's where we're starting to see some of this balancing act, which again, declines tax revenue, hurts exports, hurts investment in the country, hurts jobs growth. All of these things on the top of massive amounts of debt is just a ticking time bomb. So then when we look at where are the most industries getting hit, it shouldn't surprise you that it's tech. Why? Because tech has been a focus. If you claim to create a tech company, you could get borrowing from the PBOC, from the CCP, from your provincial government fairly easily with limited questions asked, because this is their goal. Their goal is to build technology. So what do? They write loans, blindly, and all of a sudden, when they go to say, okay, well, where's your asset? What are you making? Oh, that person's gone. They've skipped town. They're now out of the country. They've taken the money. They've bought a $20 million apartment in New York City. They're going to turn around and sell it for $12 million because who cares? The money's now clean and they're out of China. So there's a lot of that also happens, which is why when Xi first really started to crack down, especially on the PBOC side, they sent PBOC representatives into every province. They tried to look through all these different components. Oh, and by the way, Merkel says Germany will extend partial lockdown until December 20th, just an FYI as it comes across. But these are things that are an issue because technology is the focus. Technology saw a drain, and now they're defaulting. And this isn't going to increase that bad debt expense. It's going to increase the pressure on an already levered financial system, which is going, again, issue to Chinese growth. Now, when we look at the corporate sector is driving the share of R&D, this is why they're investing. The corporate funding, the government funding, like corporations, they are trying to get private sector and try to incentivize R&D on an IP level to really get people to do things and to invest in themselves, but also in the economy, which was part of Made in China 2025. Attract top talent, give them the ability to have some sort of IP, and provide a safe home that they don't have to worry about getting polluted or some sort of ailment from just terrible air quality, which is why we talked about the air we breathe and what we covered in the last segment, in the last week's China episode. So this is not surprising to see, but the problem is the corporate funding share of total is starting to roll over and is starting to get concerning for China and the PBOC, because we are seeing a big increase in either delinquencies and or filings of bankruptcy, which is going to put weight on, well, who's going to provide that backstop? And just to kind of give some pictures of China's top-rated corporate bonds, this is after the mounting credit fears. You can see how we've had a huge drop down, where some of these bonds are now down anywhere from 20 to 50%. As these fears mount, and these are large conglomerates. These are large companies that span outside of just China, which is, again, pointing to the pressure, pointing to the issues of growth, which is why when I look at Chinese data and I look at what's to come, it's hard to see how this is going to normalize. Even with the ACEP trade deal, which we talked about last week, and the ASEAN and the issues that they're trying to create these free trade. It's just they're so overextended. There's going to be a haircut. There's going to be pain, and it looks as though, again, this is a story told 1,000 times. I was as bearish as I was China in 2016. I recognized the fact that they were gonna borrow into oblivion. They were gonna save the world with stimulus, and they did. And they stimulated from end of 16 straight through 18, and you saw it reflected in global GDP growth. I just don't see them coming to market at the same time, and that's why I get concerned on not only global growth, but in terms of China's ability to get out of this problem as they have previously, because what has been done in the past can't be done this again, and it can't be done the same size. And now you have an issue with currencies and inflation and all the other fun geopolitical happenings, which is going to create this strife, these issues, which is why we're always laser focused on China, obviously second largest economy in the world, numbers that don't make much sense as an uncertain term with Biden coming in on how tough will he be on China, Chinese corporations, and what is trade going to look like as we try to go get more aggressive against Chinese trade actions, not only in the South China Sea, but also on a global footprint. So we've covered a lot. If you have any questions, we cover China and all these other issues in grave detail. We hope you had a great Thanksgiving. Hopefully you have some fun plans to carry the good times through the weekend. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.